On Friday, the liquidity outflows and market volatility showed that it was no longer possible to restore the necessary confidence and that a swift and stabilizing solution was absolutely necessary. This solution is the takeover of Credit Suisse by UBS. It is supported by the Federal Council following several meetings with the Swiss National Bank, with our regulator, the FINMA, with Credit Suisse and UBS. And the Federal Council welcomes this takeover and is supporting it by guaranteeing the framework conditions necessary for its success. The Federal Council is therefore confident that in this difficult situation, the takeover of Credit Suisse by UBS is the best solution for restoring the confidence that has been lacking in financial markets recently, and for best managing the risk to our country and its citizens.
Following a panic-filled week, the Credit Suisse saga finally came to a tipping point on Sunday evening. Swiss investment bank UBS announced that it has agreed to take over Credit Suisse in a deal brokered by the Swiss government. The all-stock deal values Credit Suisse at a little over $3.2 billion and comes with liquidity assistance guarantees of about $216 billion from Swiss regulators. UBS's shotgun wedding to Credit Suisse implies a discount of over 60% on the bank's valuation as of market close on Friday. UBS has also received a guarantee of $9.7 billion from the Swiss government to cover potential losses associated with the acquisition. But how did a 167-year-old global investment bank fall to its knees in such quick fashion? Credit Suisse's stock has lost about 97% of its value from the all-time high of $74.5 hit in 2007. In the last 3 years alone, the bank's stock price tumbled by over 85% as Credit Suisse was hit by one scandal after another, mostly concerning governance and risk management problems. The bank also made multiple changes to its senior leadership over the last few years as it tried to calm nerves about its future. While Credit Suisse has had a long and checkered past with controversy, its involvement in the blow-up of Archegos Capital and Greensill Capital dealt body blows. The bank lost $5.5 billion in its involvement with hedge fund Archegos and recorded a loss of another $1.7 billion in the collapse of supply chain financing firm Greensill. Later in the year, Credit Suisse also pleaded guilty to wire fraud in association with a tuna bonds loan scandal in Mozambique. The tuna bonds scandal involved widespread corruption and is said to have contributed to pushing Mozambique into financial crisis. The laundry list of scandals continued over the next year as leaked data from the bank showed it supported clients involved in illegal activity. In June 2022, Credit Suisse was also found guilty of laundering money for a cocaine trafficking ring in Bulgaria. Although Credit Suisse embarked on an ambitious restructuring plan in October 2022, it continued to suffer significant deposit outflows. Credit Suisse clients pulled as much as $88 billion from the bank in the first few weeks of November 2022, according to a Bloomberg report. The continued outflows put the bank on unsure footing, even though its financial position seemed to reflect that Credit Suisse was well capitalized. Even as Credit Suisse moved towards stabilizing deposit outflows, banking turmoil, which started in the United States, made its way to Europe in quick fashion. The failure of Silicon Valley Bank on March 10th and coinciding failures at Signature Bank and Silvergate Bank shook banking stocks worldwide, and Credit Suisse seemed to be the first on the chopping block as the bank's shares nosedived. Adding fuel to the fire was an admission from the bank that it had observed material weakness in its financial controls for the years 2021 and 2022. While this pushed sentiment even more negative, the final blow seemed to come from the bank's largest shareholder, the Saudi National Bank. SNB's chairman, Amar Al-Khudairi, said in multiple interviews on March 15th that the bank will not commit to giving Credit Suisse any additional capital. The statement came even as the lender was struggling to stay afloat. The 1-2 combination pushed CS stock deep into the red before Friday evening, brought a much-needed pause. Authorities raced to reach a solution over the weekend as a deal was hammered out which would see UBS absorbing all of Credit Suisse and then proceed the reorganization of the bank. Interestingly enough, UBS termed the deal an acquisition, while Credit Suisse chose to go with the word merger. Late on Sunday evening, Swiss authorities and the two banks' senior management announced the deal, hoping to calm financial markets roiled by volatility. For now, Credit Suisse seems to have found a home with generous help from the Swiss government. The combined entity will create Switzerland's largest bank, with a global asset size of over $5 trillion and will involve merging two globally systemically important banks. The deal has also received statements of support from the US Federal Reserve and the European Central Bank. Just how well the market digests this deal remains to be seen and could determine how long global banking is covered by the clouds of uncertainty.